Jonathan, this has, of course, been a wild year for, I think, pretty much every asset class out there, whether it's stocks, bonds, and, of course, crypto here. Is there opportunity right now, though? It seems like the big reaction that we saw, the knee-jerk reaction to CPI, seems to be there were a lot of people waiting for this moment where they felt the all clear was there, and now is the time to come back in.
Yeah, well, let's go back to where we've been, right, year to date. We're looking at equity markets that have been off, over 20%. Fixed income markets off close to 20%, depending upon the type of fixed income vehicle that you're invested in. So I think really both equity markets and fixed income markets wanted something to feel positive about. I think that's one good thing, is that there is cash on the sidelines waiting to put to work. You see the equity markets rallying anywhere from 3 to 4% today. You see the fixed income markets, treasury markets coming down anywhere from 20 to 30 basis points in treasury yield.
Can we talk about that?
Yeah.
There's been a lot of concerns about liquidity in this market. Is this a healthy repricing? If you get a CPI print like this, you have to really rethink how quickly the Fed goes? Or is 30 basis points on the day highlighting some of the technicals and the positioning in this market?
I think it certainly speaks to the technicals, right? And it speaks to the volatility that we've seen. We've seen it outside of the United States when we talk about the gilt market, the volatility in yields that we've seen there. There's nothing really new here in terms of volatility. One week we've got yields moving up 30 basis points. The next week, one day today, yields moving down 30 basis points. So I really think it speaks to the volatility that is still present in the markets. Getting back to the CPI print today and some of the positivity that the market felt with those headlines and core inflationary numbers, I do think it's the markets getting ahead of themselves, though, a little bit. So when we read into the CPI print, especially those core numbers, what we see is that some of the services sector, especially when you talk about shelter, tends to be a bit more on the sticky side. So I think that when you've got investors out there that seem to think that obviously today's numbers that inflation is sort of waving the proverbial white flag. We don't see that at this point in time. It's still very data dependent. This is one very good data point. But let's be honest, headline inflation is still north of 7%. Core inflation has oscillated right around 6%. So I don't think we're there yet.
Put this into context, though, of what the Fed at least has communicated so far. And by the Fed, I'm talking about Jay Powell, not all of the minions around him. He's basically made it clear there's going to be another hike in December. We don't quite know 50 or 75, but it looks like he's entertaining the idea of maybe 50. But he also made clear that they're going to continue to that terminal rate into 2023, and they're going to hold there. Does this report, I know one report doesn't make a trend, but is there any evidence out of this one report this morning that that position could be altered?
I think it confirms that position, really. We've been expecting 50 basis points in December. I don't think today's print really changes that. Another 50 basis points is what Aberdeen expects in the first quarter of next year. I don't think this print changes that. I think we need to see a real longer-term 3 to 4 month trend of core CPI coming down before we see the Fed pivot. Markets right now, when you look at the reaction today, is pricing in a pivot. I don't think this number warrants a pause, maybe a touch on the brakes, but certainly I think all systems go on taming inflation. Remember, the Fed's got a 2% target on inflation, and we're still north of 7%, so we've got a long ways to go.
Talk to us then about the relative value of about 4% all the way across the curve. Clients can finally come to you for the first time in decades and say, hey, it's 4%. That's actually worth something now, right?
Yeah, it's been a really difficult conversation in this low interest rate environment for fixed income investors, right? And I think when we look at the market backdrop, we look at some of the headwinds headed into 2023, and I think fixed income assets look really attractive to both retail as well as institutional investors. On the institutional side, especially on a risk-weighted basis relative to the equity markets, you're looking at U.S. investment-grade corporate bonds yielding in and around 6%. Compare that to the equity markets, where you look at earnings yields in the S&P 500 right around 5.5, 5.25. year, we think that's a buying signal and really looks attractive in U.S. corporate bonds. Taylor, something that I think is probably near and dear to you, in the municipal market, we actually think things look even more constructive. On a taxable equivalent basis, you can find municipal debt north of 7%, in some instances closer to 8%, depending upon your state, municipality.
And he's
that you
in
live
his high tax Illinois. He likes that.
Absolutely.
Well, he's got to be loving the upgrade that he saw recently.
get me
I've been telling her all day. I said, you need to do a whole half-hour special on that. She's not interested.